The Fed left interest rates unchanged, reaffirmed it would end Treasury purchases this month as scheduled. It also lowered the forecast for U.S. economic growth this year. Paul Ballew is with us now. He is with Nationwide Mutual Insurance. He is a former senior economist for the Federal Reserve Bank of Chicago, and he is now with us on the phone from Columbus, Ohio. Paul, thanks for joining us this morning. You're in an insurance company now. You used to be a sales manager at GM. You were at the Chicago Fed, so you have theoretical experience. You have practical economic experience. Do you think the Fed's tone is too pessimistic?
No, I would say the Fed's starting to align with where private forecasters have been. We've looked at this recovery for quite some time as having a lot of weight on its back, and it would be really difficult to see growth get above 3% given all of the pressures on the recovery. So the Fed forecasts are starting to come in line with what we've been seeing in the private sector. And really the big challenge going forward into next year is, can we see growth at a level where we start generating some job increases?
So the Fed is in line with what the private sector has decided or analyzed and knows to be true. Speaking of that private sector, you left GM, but I'm just considering auto production, auto sales seeming to be a leading indicator this year. I mean, are there optimistic signs from corporate America that Bernanke is ignoring?
Well, I wouldn't say the Fed's completely ignoring. I would describe those signs as cautiously optimistic. Vehicle sales have recovered. Vehicle production in the second half of the year will be pretty brisk as we try to rebuild some inventories. We do look at corporate balance sheets and corporate profit levels as being pretty healthy. Overseas, a bit of a mixed equation right now, but when you bring it all together, there's no reason why we shouldn't see 2.5% to 3% growth in the third and fourth quarter. That's still not brisk given the downturn, but it's better than what we're seeing in the first half as we've gone through this flat spot. So I think the Fed, like all of us, are trying to gauge just the trajectory of the recovery. I think when you do the homework, 2.5% to 3% feels about right for the second half. We'd like to see stronger growth, but we really don't see things lining up to accomplish that.
Speaking about feeling right, at this point, inflation is pretty much where the Fed wants it to be. That's what one of our guests, Jim O'Sullivan, who's chief economist at MF Global, told us earlier. This is in terms of underlying inflation. Do you agree with that?
I would say the Fed's very comfortable with where we're at from an inflation pressure standpoint. They're really not seeing at the core and inflationary pressures build. There's so much slack in the economy. There's so much slack in labor markets that they're pointing to that. That doesn't mean their exit strategy is going to be easy when they begin to make the pivot, pick a date somewhere in 2012 or 2013. But right now they're very comfortable and directing their attention where they should direct their attention, and that is in signs of weakness in terms of overall activity, as well as questions with regards to external events in Europe and what's going to happen in terms of fiscal policy.
Inflation, how much of a part of that equation was part of the no hint of QE3, the absence of a hint that we didn't hear yesterday?
Well, I would say QE3 is on the shelf right now for a variety of factors, one of which is the Fed is comfortable that the deflationary concerns they saw a year ago have dissipated. But then secondly, not exactly clear what benefits QE3 would bring. We're really not facing a liquidity issue in the marketplace. We're facing a structural issue in terms of housing and related factors, and we're facing a demand issue. So if you're the Fed, at some point you're pushing on a string. Therefore, why QE3? It's pretty hard to justify in the current environment. So I would expect that that discussion will probably not rear its head for a while again, unless something more severe happens in global financial markets.
Paul, glad to have had your perspective as a former Fed senior economist at the Chicago Fed, also spent 2 decades at GM, is now with an insurance company, Nationwide Mutual Insurance, saying basically the U.S. does not have a liquidity issue, it has structural issues.